Welcome back. Holiday spending was on the rise this year with Mastercard's Spending Pulse survey showing a 7.6% jump in total retail sales. That's between November 1st and December 24th, excluding autos. Mastercard senior advisor and former CEO and chairman of Saks Inc. is Steve Sadove. Steve Sadove joins us now to break down the report. Steve, thank you for joining us here. Looking at the headline numbers, total retail ex-auto up 7.6%, in-store 6.8%, online a 10+% jump from last year, but not increases across the board in every category that we're seeing.
Yeah, Jared, I think that's a good description of it. This was a very solid holiday season. 7.6% was right in line with what Mastercard had forecast for Spending Pulse. And remember, this is across all forms of tender, including cash debit. So this is a perspective on what really happened during the holiday season. I would describe the number as solid, but a little bit different than some people had thought coming into the season. It was more online. Online had been not growing nearly as fast. Remember, you had rapid online growth in the beginning of the pandemic. And over the last early part of 2022, it slowed dramatically. You saw a resurgence of the online shopping. It was a more promotional environment than a lot of people thought. There was the excess inventories that were sitting in the system. Much of that got discounted during the holidays. So part of the story is yet to be written in terms of what happens to margins. It was a more experiential holiday season. You saw it in the restaurant numbers, people wanting to get out. So you've got that pent-up demand for experiences that are driving some of the behavior. And I think you see a slowing environment versus what you saw in the summer. In the middle of the summer, the growth was 10 to 12%. Now we're looking at 7.6%. So while a healthy number, it's clearly recognizing a slowdown, and we're in an inflationary environment. So that's eating up and contributing to a lot of the growth.
Hey, Steve, it's Julie here. It's good to see you. I want to zero in
Julie.
on that in-store number in particular, which rose, but is a lot lower than some of the earlier forecasts from earlier in this season. What do you think is going on there? I mean, listen, I went to the mall a couple times over the holiday season, and it was packed, but I guess that wasn't true across the board.
Well, first of all, I think 6.8% is a very solid number. So you had historical declines going on in the in-store prior to the pandemic. So I would characterize as not a bad number at 6.8%. Again, much of it inflation driven. It was, I think that there were spurts early in, this was an early season. Remember, Amazon had a second Prime Day in the middle of October. A lot of the big retailers followed. So there was a big burst early in the season. You also saw a very big burst right around Thanksgiving. The Black Friday, Cyber Monday was quite strong. And then you had this big lull early in December, and then a very good recovery at the end of the season. Now, part of that is the consumer focusing on value and picking up some really good deals. But I think that the in-store numbers at that kind of level was reasonably healthy relative to the longer-term trend. Right now, I think, Julie, what's going on is I would call it a reversion to the norm. And we're seeing these variations early in the pandemic, the big wins by the stay-at-home categories. As you came out of the pandemic, the experiential categories, we're seeing some very big increases. You see it in the restaurant numbers. But now we're starting to ease back towards a little bit of normality, because if you look at it versus 3 years ago, the overall growth among the categories isn't that differentiated, other than some of the restaurants really seeing some good performance. But when you see declines on jewelry, for example, that's against a very high number a year ago. So, or electronics, where everybody bought their television set early in the pandemic. So I'm a little bit less concerned just on the year on year as I am looking at the longer term trend. Department stores at 1% is a slowing from where they had seen earlier in the season, early mid-year. They were seeing some bigger growth numbers. So I'd be looking at that. That's getting back towards that secular declines that they had seen prior to the pandemic. So again, experiential is great, but you've got to deliver on the consumer experience. Otherwise, these trends don't stay together longer term.
And Steve, 2022 is a year that both, I guess, the average consumer as well as business owner were rocked by inflation. And we saw inflation expectations and actual inflation explode to the upside. We're expecting, well, there are some expectations of a big decline next year, or at least a modest decline. Just wondering how some of the retailers have adjusted their margins to deal with this new norm, and which hopefully is not a new norm, but we may have to take it as such.
Well, I think inflation has been a massive issue for all of retail and for consumer brands. I think the winners have been the ones that have been having pricing power and be able to pass on their cost increases to the consumer. As inflation, supply chain costs wane, you're starting to see a slowdown in some of the commodity cost areas. You're getting a major degree of resistance from retailers to accept price increases right now. I think that as we go into 23, you're going to see less increases passing through from the brands to the retailers. And I think that you're going to be in an environment where it's going to be about differentiation. Now, the inflationary impact really varies from category to category. If you look at food, we've seen close to double-digit inflation, and a good part of the increases you're seeing in grocery and restaurants are driven by that inflation. If you look at other categories like apparel, where you're seeing a lot of excess inventory that's being discounted, I actually don't think you're seeing as big an inflationary impact because of the depressing effect of the discounting. So the inflation is really going to vary from category to category. And I would anticipate that as retailers get their inventories in line, because you're still not at a point where inventories are in line because of the dislocation and the wrong categories being bought too heavily, I think you'll see a little bit less inflationary pressure because there won't be as much discounting going on. This was a very different year because of the amount of discounting.
Yes, it has. We've all been watching the inbox indicator very closely, Steve, how many sales we've been getting in our inboxes, and there's been an uptick for sure. Thank you so much for joining us. Happy holidays and Happy New Year to you. Mastercard Senior Advisor and former CEO and Chairman of Saks, Steve Sadove. Thanks so much, Steve.
Thanks.